From September 1929 to today, almost 96 years, the S&P 500 has beaten gold by less than 7%. That difference is pretty much nothing. There's almost no difference whatsoever. On a 100-year timeline, it's like a rounding error. I have personally traded single days volatile enough to wipe out that entire spread. When I saw that number, I double-checked it, thinking this must be some kind of a mistake, but it's not a mistake. Everything I've ever read has always led me to believe the S&P 500 would clearly win if you just waited long enough. This data not only showed me that belief was wrong, it showed me that it is completely wrong. And digging into the numbers even deeper showed me there is a time-tested way that it has reliably predicted when the S&P would and would not outperform gold, why this matters, and how you can spot this difference for yourself. If you're ready to dig in, be sure to hit the like button, and remember, none of what you're seeing today is financial advice. I'm just sharing my 2 cents on what I would personally do. First, a quick background so you know where this is coming from. I'm an engineer and I've been building software most of my life. I started programming at the age of 10, and professionally I've been writing software since 2010. I've also been active in the market since April 2007, including building quantitative systems. I approach markets the same way I approach complex systems: data first, opinion second. For this analysis today, I pulled gold prices, S&P 500 prices, and calculated the gold to S&P 500 ratio for every single month going back before the 1933 gold confiscation. That's more than 1,500 months of data, all aligned by the same starting points. And there is a repeatable pattern in this data. Before I show you the pattern, we need to agree on one thing. What does value actually mean? I had an equally mind-blowing realization a few weeks ago when I made my market signals number 4, where I wanted to see how much the purchasing power of gold has changed in the past 100 years. So I went back exactly a century to 1925, and I found that the most popular car in America at the time was the Ford Model T Runabout. It cost about $260. And with gold around $20.67, this works out to roughly 12.6 ounces of gold. So I asked a simple question: what does 12.6 ounces of gold buy today? The answer is a modern equivalent, one of the most popular cars now for decades in America, the brand new Ford F-150. Same ounces of gold, same purchasing power, and for what it's worth, the Consumer Price Index, or CPI, would seem to indicate that the most popular car in 2025 should only be 19 times the price of a car 100 years ago, meaning a new, number 1 most popular car in 2025 should only cost about $4,941. This alone tells you everything you need to know about the CPI numbers. In the past 100 years, gold didn't increase its purchasing power. It preserved it perfectly. But the dollar price of gold went from about $21 an ounce to over $4,300. That looks like profit, but it's an illusion created by changes in the money supply. And it's an illusion you get taxed on, which makes this that much more important. The other night, when I was still trying to wrap my head around all of this, I started explaining this to my daughter using coins. Imagine you have 2 coins that both happen to be quarters. That's 50 cents of purchasing power in your 2 coins. And the government next forces you to swap your 2 coins for an exactly the same value in 50 pennies. This is exactly what the government is doing invisibly when they print money every single day. You've gone from having a mere 2 coins to now having 50 coins, but you still only have 50 cents. Nothing else has changed. Now imagine the government says, you used to have 2 coins. Now you have 50. That's a gain of 48 coins. You owe tax on your 48 coin capital gain. When we compare it to the gold example with the Model T, your purchasing power stayed the same in this example, and you technically haven't grown your wealth even a tiny little bit. But because the government grew your coin count from 2 to 50 coins, you must be taxed on your supposed profit. That's what inflation does over long periods, and that's why I use gold as a constant measuring stick. So the real question becomes, when do purchases of stocks actually grow your purchasing power? And when do they simply keep pace or even lag gold? That question led me to the key discovery I'm about to share in detail with you today. When I mapped the ratio between gold in blue and the S&P 500 in orange, with the ratio between them in gray, a specific range kept appearing. I call it the nullification zone, and it sits in between the 0.6 and 0.7 ratio range. I've highlighted this level in blue here. So these are all the dates where it went into the nullification zone, and the ratio is in this column. Historically, when purchases of stocks were made while the ratio was in this blue range, the long-term advantage of stocks compared to gold tended to disappear completely. Over long periods, the outcomes of investing in either gold or the S&P ended up being extremely close. This happened across decades. Actually, it happened over full lifetimes. I cannot overstate how insane this is. I'm going to show you the evidence in the specific charts in just a second, but ultimately, exactly where this ratio is what matters, and the direction also matters. Historically, when the ratio was falling through the 0.6 range that I have highlighted in light red here, all the way across, it usually continued falling. But then on the flip side, when the ratio started rising up through that red line, up through the 0.6 nullification range, it usually continued rising. When it rose, it signaled a slow improvement in the attractiveness of entry point in stocks. As the ratio moved well above 1.0 like it did here, purchasing stocks at that time became increasingly attractive because their relative outperformance versus gold over the coming years increased sharply. Once I understood this pattern, I tested across history, and everything I found I'm about to show you. In September 1929, the ratio was around 0.65, right inside the nullification zone. I plotted performance forward from that point. From September 1929 to today, the S&P 500 beat gold by only a single-digit percentage right here, literally less than 7%, 7.0% in 96 years. When I saw this, I literally said out loud, "You have to be kidding me." This same outcome shows up again and again. What you see after 1929 is the ratio sharply rose after this period, going from 0.65 all the way up to 4.7. This was leading into the Great Depression, the September period. Every single time the ratio crossed the nullification zone in blue, you see it peaked around June 1932 with a ratio close to 5. And if you look at what would have happened, as always, with such a huge ratio, 4.72, gold massively underperformed the S&P, while the S&P beat gold by about 665%. If we look back at the main chart, we see that as the ratio fell again and crossed the nullification zone again in 1959, we had a ratio near 0.61, and it was rapidly falling. So key here, in the nullification zone, in the 0.6 range, gold and stocks after then did extremely close to each other, almost identical performance, less than a 1% difference. And keep in mind, this is 67 years ago. Those ratios were in the nullification zone 67 years ago, 1959. From that time, we've had almost identical performance within 1%. As is always the case, the ratio continued falling, and it bottomed out near the upper 0.3 range right here. And every year here where it's in that below the nullification zone in the 0.6, goes in the 0.3s, every year gold is outperforming, S&P is underperforming gold. Keep in mind, every single one of these is if you had invested at that time and held for almost 60 years. I mean, we're talking 55 to 60 years, held S&P, held gold. The gold would massively outperform over 55 to 60 year time frames just because we're down below that nullification zone ratio. Like here, this is if you bought gold and S&P in August of 1967. The ratio then was 0.37. And if you just held it for 58 and a half years until now, the gold would beat S&P 500 by a massive 67%, like you see here. Gold is in blue, S&P is orange. But like it always does, the gold to S&P ratio doesn't stay down forever. It starts creeping back up again, and it gets into the 0.6 range again. In 1972, it goes up to that 0.6, And then in 1972, the thing that's so wild about this one, there we are, nullification zone 0.6. If you had invested in both S&P and gold back all the way in 1972, that's 53 years ago. The performance over the next 53 years was only 0.2%. So we're literally almost exactly the same. This just keeps showing up over and over again. As with always before, though, that ratio, it was rising going in. It keeps rising upward. And this had to do a lot with the U.S. getting off of the gold standard back in the early 70s. And then for the next 23 years, you see there, the ratio continued to rise through that nullification zone in 1972, kept rising, and it just hit crazy high levels, unheard of. But lots of that period, it was over. See, the ratio went over 1.0 there, and it stayed over there until early 1990s. And all of that period, as is always the case, you've got the high ratio means high outperformance by S&P, underperformance by gold. If I look at this crazy one right here in January 1980, it hits 6.3. I'll just show you that chart. Notice all of them gold underperformed with that high ratio. But if I just look at this one in January 1980, I mean, look at this outperformance of the S&P. It beat gold by 923%. Gold lagged S&P by minus 90%. As always, though, that was a peak, starts coming back down to earth, and it crosses 0.6 range in the mid 90s. Specifically, it's falling down into 1995, October 1995. Ratio is about 0.65. As always before, we're in the nullification zone. If you had invested then when it was at 0.65 until today, they've almost equaled each other, S&P and gold, right neck and neck with each other. And that is going back 30 years. That was 30 years ago. Again, that was when the ratio was in the nullification zone in the 0.6 range. It was actually at 0.66, so was falling before. It keeps falling. And when it's falling like that, that signals better gold purchases ahead. And if we look, after it crossed over that ratio there, it was falling. It crosses over the nullification zone in blue, October 1995, keeps falling, going down lower and lower. And all of those periods where it was a very low ratio, gold outperformed. And the lower it got, the more massively gold has outperformed from that time until modern time. And note, I mean, these are between 18 years and 30 years ago. So this is a long time frame here. If you specifically look at this one in 1999, it had a 208%, gold had a 208% outperformance. If you had invested then, May 1999, gold to S&P ratio is 0.2. Gold has beat the S&P 500 from then until now by 208%, which is, we're talking more than a 3x outperformance. But like's always the case, that was bottom. The ratio starts rising. Notice it's like around here, 0.65 range. That was in January of 2008. It crossed over right here, 0.63. And as before, they've been neck and neck since 2008. Over the last 18 years, if you would have invested in that when it was crossing over the nullification zone, see there, 0.64, the gold and S&P they've equaled each other in terms of their relative performance since then, actually being within almost 3% of each other over the past about 18 years or so. Yeah, 18 years. The ratio had been rising up. It kept rising, specifically going through, that's 2008. It kept going up. It stayed well over 1.0. It didn't, and I'm just showing as an example, it ultimately ended up peaking in October of 2011 at 1.56, but even here, it was getting well over 1 back in March 2009. If you would have invested in gold and S&P in March 2009 with that big ratio well over 1.31, S&P is massively outperformed as we'd expect. But the ratio is high, well over 1.0. Notice the gray, it's a scale on the right side here. So ratio is going to fall. It had been falling before this. It continued falling. It fell back into the nullification zone, down into the nullification zone down in October of 2014. It hit 0.6. And as expected, it's October 2014. Since that time, gold and S&P have been virtually identical investments. You have a 0.6 ratio. Gold has only outperformed S&P by 2.4%. They're effectively the same. Okay, the thing to remember with all this, these are completely different eras, all of these. The first one of these was before the Great Depression, when you couldn't even drink a beer legally in the United States. And as a side note, I had never noticed before that Senate Joint Resolution 211, or the Blaine Act, passed the House on February 20th, 1933. What this set the 21st Amendment in motion. And for anyone who doesn't remember, the 21st Amendment repealed Prohibition and made alcohol legal again. Then, only 44 short days after Resolution 211 passes, on April 5th, 1933, Roosevelt tells everyone in Executive Order 6102 that he's going to take everybody's gold. He must have hoped everyone would get so drunk they wouldn't notice their gold had been replaced with a bunch of fiat currency they were about to inflate to minus 99% over the coming decades. Ultimately, I'm always adding and adapting my investing strategies, but seeing all of this over the past week has completely changed how I think about long-term investing. It showed me that time alone doesn't guarantee better results. It doesn't guarantee the S&P 500 is going to be the best way to invest your money. There are long, decade-plus stretches where the gold to S&P 500 ratio dips below the 0.6 range, where historically buying stocks underperforms gold even for the remainder of most people's lifetimes, like was the case back in 1959, all that. And then again in the 90s, going into the early 2000s, and now again going into the 2014 range up to present day. We see that in periods like 1966, where the ratio was 0.38, from that time to present day, gold has massively outperformed the S&P 500 by over 60%. This was almost exactly 60 years ago, and gold has predictably blown away the S&P. Seriously think about this. The main thing is with all of this to understand where you are in this cycle. Today, as I'm recording this video, the ratio is sitting around the 0.668, about 0.67 range, which is putting us back in the nullification zone. The ratio has been rising through this range for the last few years now, and historically that has led to continued rising, so the gray bar, remember, is the ratio. So my expectation is this would likely continue to rise. And again, this is just my opinions. I'm not trying to advise anyone on what to do, but if it rose through the nullification zone, this would indicate a situation where S&P would be outperforming gold. Currently, we're in the nullification zone, meaning it's like a crapshoot, basically. Typically in the past, when it's gone over that nullification zone, it often goes quite a bit over. If that were the case, that would signal massive outperformance for stocks above that range. Ultimately, this is what I'm watching, and this is how I'm framing my decisions going forward. It's all about probability. It's not certainty. It's just watching the data. When stocks do become attractive, I don't personally ever just buy the index. It averages together all of the really awesome companies with a lot of below average debt-strapped ones that I don't like. What I like doing instead is meticulously digging into high-quality companies that have been pulled down by the broader S&P index, but that are still doing well. My exact process is what I plan on showing you in the next market signals. I'll show you how to do it completely for free using totally public information any of you watching right now can dig into in literal minutes. I'm going to break this down in detail in my next video step by step in ultra simple details everybody can understand. I think there's storm clouds brewing ahead, but I also think that some of the best opportunities in a lifetime are going to be found in the wreckage after the storm. Be sure to subscribe if you haven't already, because I'm going to be documenting all of this every step of the way. And while you're here, be sure to check out this next video that YouTube has custom picked just for you. I pack all my videos with as much helpful information as possible, so you definitely don't want to miss it.